way of looking at a type of business model that I really, really like coming into this environment. So the thesis around a high for longer inflation, I'm looking at companies that have asymmetric upside to a heightened inflation environment, so that they have call option on revenue without commensurate increases in expenses. So your royalty type companies, I've talked about those till I'm blue in the face. You've put a company on my radar that is not a royalty company. However, it would appear to have a toll booth type aspect to its business and being a realtor of sorts. So it's a capital light business with call option on volume and price. So the real estate that it sells, the price going up, they get increased clip of the ticket, increased volumes, increased listings. They also get an increased clip of the ticket. You really don't need a lot of infrastructure to run a realtor type business. So I'm thinking, hey, this could fit the bill. The company you've mentioned, which has got my attention, is called Douglas Elliman Incorporated. It has been absolutely walloped. Over the last 2.5 years, it's down 60%. Talk me through the thesis, and then we'll talk numbers on Doug, ticker DOUG.
Yeah, absolutely. So, yeah, one of the theses that I've been kind of focused on is the idea of the K-shaped economy. That one branch of the K is going up and one branch of the K is going down. So the luxury high end, people that are, if you're a NVIDIA software engineer and you suddenly find yourself with $20 to $30 million worth of stock options, you decide not to go into work on Monday and just cash out. Well, you can now get 5% on cash in your money market accounts. And that income is really, buoying the upper class. And if you're middle class, times are pretty tough. So you hear Walmart on all their earnings calls are talking about the consumer trading down. So middle class focused businesses are getting hollowed out, and the middle class is shopping at the discount shopping stores. So the lower end, it's not that they're doing well because lower class people are doing well. It's that they're doing well because the middle class people are becoming lower class. So the lower class businesses are swelling with numbers of people. And then the luxury high end are collecting 5% on their overnight rate from low interest rates. So that's the K-shaped economy with one branch going up, one branch going down. But I have a really hard time valuing luxury brands. It's just, it's not in my competence. Hats off to people who it is in their competence. So I'm always trying to find something that I can value that's in the luxury space. And then the other part is skating to where the hockey puck is going as opposed to where it is. And at some point, the housing market, the existing home market, has to thaw out. The rise in interest rates really shocked the US housing market for the sale of existing homes. New homes are selling fantastically. I've written about a few home builders. So new homes are selling very well. Existing homes are not. But interest rates aren't really high. They're high in living memory, but they're not high in historical terms. And I'm very not confident that interest rates will get cut. They might. I mean, trying to predict what's going to happen with the Fed chairman with all of his concerns, it's enough pieces of paper have been wasted typing up people's opinions about what Jerome Powell is going to do. But even if interest rates don't come down, at some point people just have to get used to them and say, okay, interest rates aren't going to come down. We have to buy a house anyway. So the realtor market has been really left for dead. And there was also a class action lawsuit. So in the United States, we have some of the highest real estate commissions in the world. And the National Realtors Association was really using their kind of trade guild status to make sure that every house that changed hands had a 6% cost of transaction, with half going to the buyer's agent and half going to the seller's agent.
6%.
Now, 6% is huge. By international standards, this is outrageous. I mean, some countries are doing like 1.5%. The United States are doing 6%. Okay. But keep in mind, real estate in the United States is one of the largest asset classes in the world because our homes are so expensive. So this is, on another stock, I wrote about this. I think that it doesn't show up in GDP because existing homes were not built this year. But the real estate commissions are a $1.9 trillion marketplace. That's enormous. That's bigger than the GDP of a lot of countries out there. That's just the commissions on the sale of residences in the United States. I mean, it's enormous. So with this lawsuit that found that the National Realtors Association were using, monopolistic practices, it was a civil suit. The jury, and this might be because of the rise of populism, the jury found against the National Realtors Association. So then you have to ask, okay, well, what's really going to change in the US realtor market? And probably the thing that people don't like is the buyer's agent. Nobody begrudges 3% to the seller's agent because they're working, they're showing the house. The buyer's agent, most people find the home they want to buy on Zillow. They try to schedule an open house, and in the process of scheduling an open house, somehow a buyer's agent shows up and signs their name on a piece of paper and takes 3%, and nobody likes it. So the buyer's agent market might get crushed. But the professional realtors, the publicly traded realtors, their 3% is probably pretty durable. It's probably not going anywhere because they're adding value. They're showing the house, they're doing drone footage of the property. They're putting it on their website. They're marketing it. They're earning it. So now Douglas Elliman focuses on the high end. It's a luxury realtor. They're the 5th largest realtor in the country in volume transactions. They did 34 billion last year. Let's see. But their average house size is close to triple some of the other people in the space. So their average house size is like $1.6 million for the average. A lot of the other realtors, it's closer to 500,000 or 600,000. So they're only in the luxury space. Now, I don't know when the existing home market is going to thaw out, but the luxury home market, a huge number of those buyers are all cash. So they don't need interest rates to come down to be an all cash buyer. But you got to be careful with that because they say they're all cash, but in a lot of cases, they're not really all cash because they use securities-based lending to come up with the cash. So some people that say that they're all cash buyers really are just taking a loan against their stock portfolio to come up with it. So then that would be interest rate sensitive. But either way, whether it's because they cashed out their stock options or because they're using securities-based lending, the high-end real estate market should be sensitive to the stock market being at new all-time highs. And the stock market is at new all-time highs. And Douglas Elliman's management team said 2 earnings calls ago that they felt like their market is inflecting. They think times are going to be good again going on from here. On top of that, their business in Florida is booming. Florida went from 21% of revenue to 25% of revenue because things are just better in Florida. This is
Well, they've got unemployed value
growth.
Degens down there buying up all these luxury condos.
No, I don't have any luxury condos of my own. We do have, a nice, modest house built in 1948 after World War II, but it's on a 1/4 acre. So that lawn was a beast to mow, especially when the grass gets tall and it's still wet after all the rain.
Just put a couple of goats in there. That's what my dad used to do.
Well, the kids probably should have a pet at some point. I don't know if goats are the best kind of pet, but it would save me on the lawn.
Yeah, depends. Okay, so they're in prime real estate, prime markets. There's negative sentiment, and I'm looking over the quarterly revenues. They are ticking up a little bit. What's the go in terms of their liquidity profile and their balance sheet? Are you looking at this as a return to, if it was a return to 1 times book, there'd be easily a double from here, and that does not seem unreasonable for this type of business. They appear to me to be the type of business that can scale well. I mean, you don't have to put that many more new real estate agents on to sell properties with the internet nowadays. What's the downside here? It seems pretty troughed out.
I think there's something going on in the accounting that everybody's missing. And that's that after COVID, you have all these real estate agents and the market's frozen. Douglas Elliman focused on luxury developments. So they were out there selling new build condos. People put down a huge deposit and they get a phone call 4 years later when the condo tower is finished being built. Right? So that sort of sales has really weird accounting features. It's like Starbucks gift cards.
Got it.
Douglas Elliman receives the commission and it gets booked in the liability side of the balance sheet or the income statement as deferred revenue. So the same way when Starbucks sells a gift card, the money they receive is a liability because someday they have to deliver the cup of coffee from the gift card.
But Doug are not in charge of the developments here, right? They're just selling.
No, they
Okay.
just deployed their realtors after COVID, after the housing market froze with the rising interest rates, on these new build projects, which do have a lower commission, but at least it's volume. But, and I tried to reach out to investor relations to get some clarity on earnings calls. On the Q&A section, people are asking for clarity. Sometimes it gets into the nature of trade secrets, like what the split is between the realtor and the real estate agent. They don't want everybody to know if that split is 50-50 or 70-30. But with a new build luxury condo development, if their past few years of income statement has the commissions paid to the realtors, but it doesn't have the income from 25 billion of development condo sales, then their income statement looks a lot worse than it is.
Yeah.
And the very first luxury condos that are the new build condos are being delivered this year. So this is for the first time they have current deferred revenue coming in this year.
And so
And
that will
there's
start to
another,
show up in the income statement this year.
yeah. So just the delayed effect that if they've paid all their realtors their commission in the past, and then they finally get to take the money, which they've been sitting on all this time, but it finally gets to go from the liability side to the income side, things should start looking a lot better just on what they've already done. And there's another quirk about new build condos, and I haven't been able to verify this with Douglas Elliman, but the traditional commission framework is the real estate agents are paid half when they receive a deposit, and they're paid the other half when the condo is delivered 4 years later. So their current deferred revenue could be half of what they're actually going to receive. So again, it's just another part of this really weird accounting system for, as if it was a Starbucks gift card. It's just these generally accepted accounting rules can get a little strange sometimes.
Yeah, and does that at least partially explain their income loss? Their net income loss was like 40 million, 40 million as of reported last quarter. Um, do they have any ongoing liabilities other than, I suppose, the upkeep of their offices? And they've got what, 120 odd offices around the US. And how long can they survive before they really start to have liquidity issues?
Yeah, that was what how I came across in the first place is before they settled with the so for that National Realtors Association lawsuit, after they went after the National Realtors Association, they started going after all the realtors. So Douglas Elliman settled all of their liability in that in 3 payments over how many years. So the most recent trailing 12 months income, there is a little bit of a loss there from that lawsuit settlement.
Okay. So
The
legal
company
expenses
has
and judgments?
um, yeah, so they've got 92 million in cash right now. And at their current income loss, not including the lawsuit settlement, I think they've been burning about 30 million a year. So that's about and they have no debt. So it's just on cash, and the market cap's only 95 million. So they're almost the true Benjamin Graham net having as much cash as the market cap. One thing the marketplace really didn't like is that even though they had cash and they said the market is inflecting, they just raised $50 million with a convertible bond.
Okay.
And they said it was for growth. So in a world where the entire realtor market has been crushed for the last 3 years, and them having no debt, they're probably going to run out and buy some of their competitors, which the inside ownership here is pretty strong too. The inside buying from the management team. This is one of those, Douglas Elliman used to be part of a larger company, and it was spun off relatively recently. So there's only a few years of history being public, but they have something like 25 years of history in business operations. And the management team has strong insider buying and strong ownership percentages. So I've been happy with the quality of management on earnings calls, and they have all the incentives not to dilute badly. And if their competitors, if there's some nice luxury boutique realtors out there that have been losing money for 3 years and will sell for peanuts, they might go scoop some of those up. And I think that's, I don't think they would have taken out this convertible bond unless they knew exactly who they were buying. So I'd expect that to happen pretty quick. That's my suspicion. But the market hated that, new debt issuance plus dilution for the convertible, and the convertible strike price is about $1.50 a share. So it'll be a pretty serious amount of dilution. It's not a trivial amount of dilution. But again, the people in control of the company, they're diluting themselves. So they better have a pretty darn good reason to do it. And I don't know exactly how the development sales income, how much it's going to be when it hits. But there's at the high end of the range, they've been profitable this whole time. It just doesn't look like it. At the low end of the range, they've been losing, $15-20 million a year, but they have $92 million in cash. So, but at some point, that existing home market is going to unfreeze. And with the K-shaped economy, probably the luxury market will unfreeze first. Because we just heard from some of the Realtors Association, they're predicting house prices in the US to go up 5% this year. So we've house prices took a small hit when interest rates rose. People thought they were going to take a huge hit. They took a small hit, and then they've been climbing back up to break even. And this is going to be the first year where prices are going to be above the interest rate rise nationwide. So then the FOMO effect hits in. People say, oh, I can't wait anymore because if I wait, I won't be able to afford the house when I go to buy it. So I think there's a good chance the housing market could thaw out because of the FOMO, the fear of missing out, even if interest rates don't come down. And in the luxury space, the market's at all-time highs. So the people that do stock-based lending or stock-based compensation, the people that are going to go buy a $3 million condo in West Palm Beach, if they see the house prices start rising again and the fear of missing out kicks in, they can pull the trigger on that and the volumes can pick up.
Yeah, indeed. And I think people are missing the nuance between the nominal interest rates and real interest rates. Yes, nominal may stay high, but inflation is still rampant. And when that inflection point hits, do you agree this is a company that can have an asymmetric rise in revenue and profitability without having increased variable expenses to the same degree?
Oh yeah, absolutely. Because I don't think they're going to bring on a huge number of new realtors to pay salaries to. Now it is kind of like a toll booth industry because they're only going to get 3% of the transactions. But then as the house prices become more and more valuable every year, that becomes larger and larger and larger over time. It doesn't have unlimited upside. There's kind of a limit to how big they can be, but the current price is so cheap that I put them in my category called 10 baggers or bust. Companies I think can go 10x from here, but they might go bankrupt in the meantime. I don't think this company has a large chance of bankruptcy because they have $92 million in cash and no debt, but it's still in my 10 baggers or bust category because I think it has a chance to tank. There's no reason why this company should be trading for $95 million when they're the fifth largest realtor doing, $34 billion of transactions, and their revenue is 3% of 34 billion. It's and in that space, in that sort of capital light services space, things can trade for 10 times earnings pretty easily. So they have, but they've been public for such a small number of years. I don't really have a good estimate for what their earnings inevitably will be when they trade for 10 times earnings. So yeah, I don't have a solid exit price target on this, but it's got to at least be a 10x. There's no reason this company should trade for $95 million. It's insane.
Yeah, we'll talk on the balance sheet and then we'll talk about the chances of a buyout. So, cash and short term, 92.6 million, as you mentioned. You got receivables at 45. So, your current assets around about 155 million. And again, I remind people EV of about 140 and market cap of 90 million. So, we look at the liabilities. There's no debt, as you mentioned. We've got a few accrued expenses and capital lease obligations and whatnot, other current liabilities at about 92 and a half. So you've got total current assets, 155 million, let's call it, and liabilities at 92.5 million. I'm not sure where they put this new convertible bond issuance, whether that is or is not included. I can't find it, but let's say it is on there. You've got, roughly 150 million worth of assets, and if I add 50 to the liabilities, you still got 140 million only of liabilities with plenty of upside. chances of this company being bought out by a larger Remax type competitor to
I
add
mean,
a
it's
boutique
always
element?
possible, but the management team, they're not insignificant shareholders. Um, and I think they would be worried about losing their cultural fit. The brand has a bit of power in the luxury high-end space. I don't think a buyout, I I don't know if it makes the most sense what always happens. One of the companies I was following in the furniture space, the Aaron's company, just got taken over by a PE firm. And this is something that I was hoping would get to a price of $30 a share, and they get taken private at $10 a share. So that's the biggest threat in small cap space right now, is that private equity just, takes all of your gains away from you and gives you a little 20% premium.
Yeah,
So it is
investors
possible, but
in Diamond Offshore and MMA Offshore and those smaller players in the field have learnt that lesson.
yeah. So it's possible, but I think that management would be worried about losing their corporate culture. I think they like being their own entity. So I feel like there's some protection against being bought out because of the strong insider buying, because of the strong ownership stake by management. When you're going over liabilities, though, so the convertible debt was issued in between quarters, so the
Mm,
most recent data doesn't have it.
that's
But
why
when
I
you look
couldn't
at the
find it.
liabilities, um, 68 million of those liabilities are that deferred revenue from the condo build out I was telling you about. It's
Why
not a
does that get put
liability.
on
They're
the
going to receive
liability
that money.
side? Is that because they have to, is that a cash outflow to their real estate agents? How does that work? I still don't
No,
understand.
it's when Starbucks receives money from somebody buying a gift card, it
Hmm.
shows up as a category under liabilities called deferred revenue.
That
That's
makes
cash
sense.
that they have, but someday somebody's going to go ask them for the cup of coffee and they have to deliver that cup of coffee.
Yep,
In this instance, it doesn't really fit that pattern because they don't have to deliver a cup of coffee to anybody.
that's what I'm
And
saying.
again, I tried to contact investor relations. I don't think it's possible that their real estate agents can go 4 years without a paycheck. My suspicion is they've already paid their real estate agent. So with this deferred revenue, they just get it without any of the costs. So when you look at their liabilities, you look at the total liabilities. Um, the let's see, the current deferred liabilities are 14 million, and the non-current deferred liabilities are 54 million. So that's, $68 million that, if you're just doing an asset liability calculation, those aren't liabilities. They don't owe anyone. That's their income, it's their future income.
Yeah, it should
So
be on
this
the
is
opposite side of the balance sheet.
yeah, this is just obscure accounting rules
Mm.
masking an incredible business, which is I think it's pretty exciting because I don't see a lot of risk of bankruptcy here, but um, usually there's asymmetric risk where if something can 10x, it can probably go out of business, but I don't really see a lot of danger here.
Yeah, I agree. I agree. Yeah, it's listed as unearned revenue non-current, 54.46 million, which if you take that out of the liabilities column, as you quite rightly, in my opinion, mentioned, um, goodness gracious, this thing can survive a cash burn for years and years and years until we get to the point where they're net income positive.
And the rest of the liabilities are lease obligations. So as long as they pay the rent, that's not a real liability either. Right. So
Yeah,
they have no
correct.
debt.
Yeah. And I mean, presumably they can downsize a little bit from their physical office presence. I mean, I know it's a big thing. Real estate agents like to have their banners and everything out there, but at the end of the day, they could tighten the belts there also, right?
Yeah, they did do some headcount reduction. They did tighten the belt. And then in all the earnings calls, everybody asked them, well, what are you going to tighten the belt even more? And management, and I think because they know they've been, pretty much profitable this whole time, they're reluctant to tighten the belt anymore. So there has been some belt tightening, but management's pushing back on the Q&A session about doing any more tightening. I think it's because when you finally break down all these wonky, obscure accounting rules, they're totally fine.
Yeah, yeah, they are with a book value that could be an easy double just to reach that. Estimates as to their ultimate earnings power. There's a tricky one.
So 2021, they earned $1.20 a share. And this is, right now they're $1.05 a share in price to buy it.
Wow.
So in a year where they're firing on all cylinders, they'll earn more than their current share price.
Mhm.
And again, in a capital light services business, a PE of 10 is very reasonable. So for them to earn $1 a share and then for the share price to trade at $10 a share, is, it could get there pretty easily. It just needs a good year. That could be 2 years away, could be 3 years away, who knows? But it just needs a good year to be a $10 stock.
Yeah, certainly presenting a compelling case. Anything else you would like to mention before we wrap it up? I think this has been a really good episode.
Yeah, I don't. It's my 2-year-old and my 5-year-old are going crazy because I got to get back to my family. But I don't know much about Australia, but I heard that Bundy rum will make you fight. Is that true?
Indeed, it will. Indeed, it will. So the priorities back in the 80s and 90s, I believe, was you went out to drink and fight, and if you met a girl, well, all well and good, but it wasn't conducive to having a good time. So, but Bundy rum, the dark rum, stay away. So your wild turkeys, your Bundy rums, but apparently your light rums, your Bacardi, that type of thing is okay.
Okay. So, all right. Thank you very much for having me on. I really appreciate it. It's always a fun time.
No, my pleasure. Look forward to doing this again sometime.